All right. Well, good morning, everyone. Welcome and thank you for joining us today for our Winter Tax Forum. My name is Farhad Aghdami, and I'm a partner here in the tax section at Williams Mullen. I'm also the managing partner of the Richmond office here at Williams Mullen. I'm joined today by my colleague, Kevin Bender, who's the senior associate in our tax department, also here in Richmond. Before we get started, I have a few housekeeping items. At any point during the presentation, you can submit questions by using the Q&A button at the bottom of your screen. We will address questions as time permits. If we don't get to your particular question during the webinar, we'll follow up with you separately. Also, if you're having any audio or technical problems, please use the same Q&A button and we'll help to resolve that issue. This program has been approved for 1 credit hour of CPE credit, and our application for 1 hour of CFP credit is pending. This afternoon, you'll receive an email with a certificate of attendance for CPE, and we'll send a separate email when our CFP credit has been approved. For today's program, I'll kick us off with recent wealth transfer tax developments, and then I'll hand it over to Kevin, who will provide an update on the new IRS revenue procedure resolving common mistakes around S corporation elections. So with that, let's get started. So I always like to start these types of updates, particularly at this time of the year, with a review of the inflation adjustments for the coming year. And a few months ago, IRS released Revenue Procedure 2022-38, which provides the inflation adjustments. And I would say ordinarily these are kind of ho-hum, like, yeah, there's, some moderate increase. Occasionally, once every 3 or 4 years, we might get a bump in the gift tax annual exclusion. But as everyone is very well aware, inflation is a big deal. And I think I did the math. I think these inflation adjustments, I think everything went up about 7.2%. So the estate gift and GST tax exemption amount, which is $12,060,000 this year, is going to go up by $860,000 next year to just a hair under 13 million, 12,920,000. I gotta say, it would just be so much easier if they could round to like the nearest $500,000, even the next $100,000. I spent all year saying, 12 million. Well, it's really 12,060,000, and now next year I'm going to be saying, well, it's 13. Well, it's actually 12,920,000. I just wish they would just round it to some nice number, but anyway, that's fine. I think the other kind of big takeaway is it's sort of the law of big numbers. I mean, when the exemption amount's gotten up to close to $13 million, a 5% increase. Let's say in 2023, inflation continues and it goes up by 5%. Well, 5% of, $13 million is $650,000. That's a pretty meaningful increase. And so I think, we will, just because the exemption amount is getting larger, an inflation adjustment applied to that number is going to produce larger exemptions. But to go up by $860,000 is really meaningful, particularly for those clients who are very focused on using as much of their gift exemption as possible. If they're married, that's what $1.7 million of additional gifting capacity. And so I think that is particularly noteworthy. The gift tax annual exclusion goes up from 16,000 to 17,000. Once again, we were at 15,000 for like 3 years. Inflation was low. It jumped up to $16,000 this year, and then in 1 year, it jumps up to 17,000. The thing to remember with the gift tax annual exclusion is, for an inflation adjustment, it actually has to go over the next $1,000 hurdle, and then they round down. So it's really, it's pretty remarkable to jump up again from 16 to 17. The gift tax annual exclusion for gifts to non-citizen spouses, so typically transfers to non-citizen spouses are not gift tax free, but they provide a gift tax annual exclusion that's essentially 10 times the size of the regular gift tax annual exclusion. And that number has gone up to $175,000, which sort of tells you that the gift tax annual exclusion is really probably 17,500, but they round down to 17. So we could very well see in 2024, if inflation continues at a even moderate pace, 3% would probably get us to $18,000. So pretty interesting, just how things have evolved in that. And then we have the 2032 valuation adjustment for special use valuation for farms, and then the 2% interest that you get on the amount for under 6166. That portion, $1,750,000, is eligible for that 2% interest rate, which is actually meaningful because interest rates have gone up substantially. The next thing is just where we are with interest rates. And December, so this time last year, the short-term rate was 33 basis points. The midterm rate was 1.26%. Long-term rate was 1.9%, and the Section 7520 rate was 1.6%. So, and that's kind of what we felt. I mean, certainly for the last 3 or 4 years, we had fairly low rates, and certainly for the last decade, we've had, on balance, historically low rates. And I think as the Fed has tried to respond to inflation, they've ratcheted up rates, and that has had an effect on obviously the bond market. The AFRs and the Section 7520 rate are tied to Treasury bonds, and so we're seeing yield, and yield is going up, and as a consequence, the AFR rates, and I've got them basically in 2-month increments. So February, April, June, you'll see that now the short-term rate for December of this year is 4.55%. We have a bit of an inversion, and you'll see that the midterm rate is actually lower, which is sort of interesting. It was that same case in October, and then you'll see that the long-term rate is somewhere in between. And so it's a very strange period right now where you've got these rates that are, they've jumped up so much in a very short period of time. And, the rate that you ordinarily, we would always default to using the short-term rate. But the reality is maybe using a midterm or long-term rate at this point might make sense. What I would say is, if you have clients who are thinking about, making loans, or there's a need to make a loan, certainly make the loan because the loan is needed, but make sure you have the ability to refinance it, to prepay the note, and maybe refinance it at a lower rate. We tell clients that when you are refinancing a note, particularly if the holder of the note, the lender, is accepting a lower rate, you need to include some inducement, ideally, for them to do that, for them to actually. So very often we'll structure notes as interest-only loans with a balloon payment, let's say at the end of 3 years or 9 years or 15 years, whatever we decide based on the term, and having some prepayment. Maybe you pay down some principal early, on that, as an inducement or as in consideration for the lender accepting a lower rate. The other thing I'll point out is that the Section 7520 rate, which is typically 120% of the midterm rate, has gone up pretty substantially. I mean, I think we enjoyed a really long period of very low rates for Section 7520 planning purposes, and now it's gone up to essentially 3 times what it used to be. And so I thought it makes sense at least to review some of the planning techniques that do well both in a high interest rate environment and a low interest rate environment. So historically, probably for the last 2 decades, we've been doing GRATs and sales to grantor trusts with low interest rate loans, doing intrafamily loans. Charitable lead annuity trusts do really well in a low interest rate environment. Now, as we're moving into, I would say, probably what is not, I wouldn't say a high interest rate environment, but a higher than certainly normal or what we've experienced in the last decade. I think other planning techniques come into play. Charitable remainder annuity trusts do well in a high interest rate environment, and personal residence trusts also do well in a high interest rate environment. Obviously you have to consider whether or not those techniques make sense or are appropriate, but from an actuarial perspective, those are certainly techniques that make sense when interest rates go up, and the math just works better. So keep that in mind. I also want to talk a little bit about Revenue Procedure 2022-32 where the IRS issued guidance that gives folks the ability to go back 5 years from the date of death to claim the unused exemption amount. So there's a concept of estate tax portability, and if the decedent's estate is over, plus any prior gifts, is over the basic exclusion amount. So this year, the $12,060,000, you have to file an estate tax return. But if the estate is not required, and that return is typically due 9 months from the date of death, you can get an automatic 6-month extension to file the return, although you have to pay within 9 months, unless you're doing other things like 6166 or 6161. But if you're not required to file an estate tax return, you can elect to file what's called a portability return, and that allows you to port the deceased spouse unused exemption amount to the surviving spouse. So if a client dies and they have a $7 million estate, they have essentially $5 million of unused exemption. And you have the ability of transferring that $5 million of unused exemption to the surviving spouse, who currently has, a $12 million exemption. They can stack that $5 million on top, and so now they have $17 million of exemption. As we look ahead to 2026 and the possibility of the exemption dropping in half, having the ability to preserve the deceased spouse's unused exemption at a time when the exemption amount is very high, and then port it kind of in the future is I think very valuable. And if you think about it, a $12 million exemption at a 40% rate, that's $4.8 million of tax savings. So, in certain circumstances, this can be valuable. The concept of state tax portability came in really at the beginning of the last decade. I think in 2010 or 2012, portability came into play. And, as anything involving taxes and deadlines, people miss the deadline. And so the IRS is gotten into the practice, or was in the practice of issuing private letter rulings, allowing taxpayers additional time to make portability elections, that they realized that they missed the election, didn't do it in time. And in 2017, the IRS said, look, we're tired of issuing these private letter rulings. Let's just make it simple. We're going to give you 2 years. So if you didn't file the return within 2 years of when you should have, you can file this within 2 years after the decedent's death. The problem was 2 years wasn't enough. And so the IRS issued this new revenue procedure, 2022-32, which extends that 2-year period to 5 years. And basically, it allows you to file a late estate tax return if you meet all these requirements. The decedent was survived by a spouse. They're not required to file an estate tax return because the gross estate is under the basic exclusion amount. They died after 2010. They were a U.S. citizen or resident on the date of death. They didn't file a timely estate tax return. And most importantly, they go ahead and prepare and file the portability return by the 5th anniversary of the decedent's death. And you have to put, I think, in all cap letters at the top of that return, filed pursuant to Revenue Procedure 2022-32 to elect portability under Section 2010C5A. And if they do that, then they should be able to port that return. It's interesting because you could have a situation where the first spouse has died, let's say, 3 years ago, the second spouse dies this year, and you can still do that. And you think about, well, that actually creates some interesting sort of, I would say, double postmortem estate planning opportunities, because you really have the ability of saying what happened at the death of the first spouse, what happened at the death of the second spouse, and maybe go back and do that. If for some reason you fall outside of this, you can still go in and request a private letter ruling. So if you're outside, if for some reason you don't fit within the parameters of this ruling or this revenue procedure, you can still go back and request a private letter ruling. It's the $39,000 user fee and the legal costs and expense of preparing and obtaining the ruling. But I think the IRS is saying, no mas. We're tired of issuing private letter rulings. Let's just make this simple for taxpayers. And I think this is a very nice user-friendly mechanism. Let's see, the couple other things. It's not available if the estate was required to file an estate tax return because it was over the exclusion amount. If it's also not available if the executor filed a timely estate tax return and for some reason did not elect portability. And then there are some situations where if you have a claim for refund, so let's say you had a situation where a person filed, let's say the first spouse died in 2023 and no estate tax return is filed. In December of 2023, the spouse makes a gift that exceeds his or her basic exclusion amount and files a gift tax return and pays gift tax. And then the estate of the first spouse files an estate tax return electing portability, which then transfers additional exemption to the second spouse. In that instance, the surviving spouse, who may have at this point now overpaid their gift taxes, can file a claim for refund. But that claim for refund really has to be done within 3 years of when the gift tax was paid, which was April 15th of 2024. So they have to file that claim for refund by April 15th, 2027, and which is less than the 5-year period after. So there's a mechanism. The revenue procedure talks about filing a protective claim for refund in order to preserve that. Okay, and then the last thing is the procedure is effective July 8th, 2022. If you filed under procedure, if you were subject to a private letter ruling request that was pending, the IRS is basically going to close its file, give you your money back, and you just go ahead and elect under this procedure. The next thing I want to cover is a case, the DeMuth case, which is, I think, actually a fairly common fact pattern that we see. That's a situation where somebody, is unfortunately they're on their deathbed, death is imminent, and the family says, let's go ahead and make some annual exclusion gifts. And it's a question of, is the gift complete if the person dies before the checks that were delivered are actually cashed and clear the bank. And in DeMuth, Mr. DeMuth gave his son Donald a power of attorney that'll authorize him to make gifts to his descendants in an amount not exceeding the gift tax annual exclusion. And for 7-8 years, the son made annual gifts to his brothers and other family members. And then in 2015, Mr. DeMuth's health worsened and he died on September 11th. And on the 6th of September, Donald wrote 11 checks totaling $464,000 from an investment account. Unfortunately, only one check was actually cashed before Mr. DeMuth's death. And all the checks were cashed within a week of the death. And the question, and essentially, they excluded this $464,000 of gifts from the gross estate, and the IRS said no, those checks had not been cashed, so they should be included in the estate. Case goes to the tax court, and the court basically said that the checks that were uncashed were incomplete gifts, and they have to be included in the gross estate under Section 2033. And so one of the interesting things is, and I think we all understand that. I think sort of the planning in that situation is you may want to use cashier's checks, because those are my understanding is those are essentially they've been pulled from the drawee bank, and so that may be the approach, particularly if you're dealing with something like that. I think the other thing is you just tell everybody you're giving them money to, deposit the check right away, or perhaps you wire the funds. One of the things that's interesting is in the IRS's pleadings, they misused some of the terms. They, I think, reversed the term drawee bank and depository bank. And apparently that was a significant, because there were a number of situations where the IRS in its pleadings had misused that, and the tax court sort of focused on that. And so I think three of the checks that should have been excluded. The tax court, I think maybe just to punish the IRS a little bit, allowed 3 of those checks to be excluded from inclusion. And so, the precision on those pleadings, I guess in that instance, was important. Another case, and this is sort of a nightmare. This is what I sort of, I almost feel like this is something that could happen to my mother. And anyway. So, you have somebody who's trying to access her bank account, and they receive an alert on the computer instructing her to contact, a representative for the company. And it may be one of these like McAfee things, and they contact them, and they basically say that foreign hackers had downloaded illegal material onto her computer and taken money from the bank account. And they basically told her that they were going to send her to an anti-fraud department, and they put her into contact with another person who claimed to be federal officers, and that they would secure all of her assets, and they would give her a check to reimburse her for withdrawals, and told her that if she told anybody about what was happening, that they would contact law enforcement, and they basically directed her to pull money from her non-IRA accounts, and then they told her to pull money from her IRA accounts, and then ultimately discovered that this is just some terrible fraudulent activity, and then finally contacted the FBI. And one of the things as they're trying to rectify the situation is the fact that she withdrew money from her IRA and wanted to have the ability to put that money back into the account. Presumably, FBI was able to recover money from these fraudsters, gave it back to her. Now she wants to put the money back into the account. And the question is, can you do that once you've made the withdrawal? They went in under a private letter ruling and essentially provided that they would waive the 60-day rollover requirement and allow her to put the money back into the IRA. Typically, when you pull money out of a IRA, you can put it back within, you can do a 60-day rollover. Here, they're outside of that, but Section 408D.3.1 allows the secretary to waive the requirement if it would, the failure to do so would be against equity or good conscience. And I think everybody sort of worries about things like this happening to their mother and, these fraudsters. And so, the IRS said that she was unable to accomplish the rollover because she was a victim of fraud, and they gave her basically some additional time to do that. So anyway, it's terrible facts, but in the end, I think it has a good result, and understand that the IRS can be sympathetic to and provide that relief. So with that, I'm going to finish up my segment of the presentation, and I'm going to turn things over to Kevin, who's going to provide an update on the new IRS revenue procedure for resolving common mistakes around S corporation elections. So Kevin, I'll turn it over to you.
Thanks, Farhad, for that great summary of recent developments in estate tax and qualified plans. I'm going to talk about the most gripping and exciting subject of all time, especially early in the morning, S corporation elections. And this actually, I should say that you should pay very close attention to this, because I'm remembering back 10 years or so, my first day of corporate tax in law school, when they said the number one source of malpractice claims against law firms had to do with S corporation elections, because there's a lot of technical rules about them, and they're easy to get wrong. And actually, frankly, I've been involved in more issues with S corp elections than sort of any other mistake. So there really are a lot of errors around S corps, and it's good to see the IRS, providing some relief. And so I think, here we go. So the IRS recently released a new revenue procedure, 2022-19, that provides relief for certain invalid or inadvertently terminated S elections and Q-sub elections. So the new revenue procedure may, or it may not, be a big deal. And we'll talk a little bit more about why it may or may not be a big deal as we go on. So as a matter of background, as most of you should probably know, An S Corp is a small business corporation that has an S election in effect under section 1362A. And then the definition of a small business corporation under 1361B is a corporation which does include a limited liability company that checks the box, which is not ineligible, doesn't have more than 100 shareholders, and there's special rules for certain family members that count as only one shareholder. Has only individuals as shareholders, with the exception of estates and qualified plans and some tax-exempt organizations and certain trusts. It doesn't have a non-resident alien as a shareholder, except in some cases a non-resident alien can be a trust beneficiary. And it doesn't have more than one class of stock. So those are your basic requirements to be an S Corp. If we could go to the next slide. So an S election, how do you make an S election? All the shareholders of the corporation on the day on which the S election is made must consent to it, right? It can be made generally before March 15 to be effective for the current year, unless the corporation didn't meet all the requirements during the year, or at any time to be effective for the subsequent year. There's some different rules if it's a brand new corporation. An S election is terminated if more than half the shareholders who were shareholders on the day on which the revocation is made consent to the revocation. The corporation ceases to meet the definition of a small business corporation, the most common reason, or passive investment income exceeds 25% of gross receipts for 3 consecutive years, and the corporation has accumulated E&P, which generally will only occur if the S corporation was previously at some point a C corporation. So if we move on, Q sub. So, an S corporation can't be owned by another corporation. To deal with wholly owned subsidiaries, there's the concept of a qualified subchapter S subsidiary or Q sub. It's a disregarded entity, but in order to become a Q sub, you have to make a special election. The requirements has to be solely owned by a single S corp. The S corp has to make an election for the Q sub. The Q sub election terminates if it no longer meets the requirements to be a Q sub, including if there's a sale of stock, which results in it being owned by multiple shareholders. So, invalid or terminated S and Q sub elections. These are most frequently discovered during due diligence, when there's some kind of capital transaction, a sale or merger, or when new investors are coming in and they're doing diligence on whether or not it's truly an S corporation before they invest. And they find out, oops, it's invalid or inadvertently terminated. The most common reasons: errors in completing Form 2553 or 8869 to make the election. They didn't make the election on time. There's a trust that's a shareholder that didn't make a qualified subchapter S trust or electing small business trust election. A shareholder agreement or some provision of the corporation's governing documents created a second class of stock or might do so, or the corporation simply wasn't operating consistently with its S corporation status for some reason, including, as we'll talk about later, for failing to file the appropriate returns. All right, so, oh no, I just found out my S election or my Q sub election was invalid when I made it or inadvertently terminated. What do I do now? So there's statutory relief, section 1362F, for S and Q sub elections that were invalid when made or inadvertently terminated. The statutory requirements for relief: the IRS must determine that the invalidity or termination was inadvertent within a reasonable time after the discovery of the invalidity or termination. The corporation corrects it, and the corporation and each shareholder agrees to make any adjustments to their returns required by the regulations to account for the fact that it was an S corporation. So the regulations provide the rules for seeking relief. Basically, you're required to submit a request for a private letter rule. The request must include a recitation of the facts showing that the termination or invalidity was not reasonably within the corporation's control or part of a plan to terminate the election, and it took place without the knowledge of the corporation, notwithstanding its efforts to do due diligence. the date of the S election or Q sub election, or its intended election or Q sub election in the case of an invalid election. An explanation of the circumstances, how it was discovered, the steps taken by the corporation to resolve the invalidity or termination, and a consent from every shareholder to make any necessary adjustments to their returns. All right. So now the IRS has issued this new revenue procedure. So previously, and still in many cases, you have to seek a private letter ruling. Now the IRS has come up with 6 common issues that they say you can resolve without seeking a private letter ruling. What you'll find out is with a lot of these probably didn't terminate or make the S election invalid in the first place, and the IRS is just providing you some comfort that you don't need a PLR. Not kind of unlike Farhad's example of late portability elections, this may be in large part an under-resourced IRS saying, stop bothering us with this stuff that's not really a problem in the first place. So here's their 6 issues you can resolve without going and getting a PLR. So certain commercial agreements that may create more than one class of stock, disproportionate distributions to shareholders, certain clerical errors on the election forms, a missing administrative acceptance letter, a return inconsistent with an S or Q sub election, and certain non-identical governing provisions. Things that are not addressed in the new revenue procedure. Late elections, but there is another revenue procedure from 2013 addressing relief for some late elections. And failure of a trust to make a Q qualified subchapter S trust or electing small business trust election, which is probably one of the most common errors I've seen. I recall one instance where we had to get consent from over 100 shareholders because of a trust that failed to make an SBIT election, and it was over 100 shareholders because I think half of them counted as members of the same family, and so that was just, a $200,000 bill to the client for a trust that didn't make a timely SBIT election, and this new revenue procedure does not cover that. So be careful when making sure your non-grantor trusts make SBIT elections. So section 1 or issue 1. Commercial agreements that create or might create more than one class of stock. So as we know, an S corp can only have one class of stock. The corporation is treating as having only one class of stock if all the outstanding shares of stock confer identical rights to distribution and liquidation proceeds. So notably, as everybody is probably aware, you can have different voting rights. You can have voting and non-voting stock as long as everybody can share in distribution and liquidation proceeds identically. So the determination of whether or not the stock confer identical rights to distribution and liquidation proceeds is based on the corporation's governing documents, its charter or articles of incorporation, bylaws, any provisions of state law, and any binding agreements relating to distribution and liquidation proceeds, notably, shareholder agreements. So according to the regs, a commercial contract like a lease, an employment agreement, a loan, or a binding agreement relating to distributions is not a governing document unless the principal purpose is to circumvent the one class of stock requirement. So according to the regs, the following do not create a second class of stock. And this is straight from the regs, right? Unless of course, there's a principal purpose. Buy-sell and redemption agreements. And there are some caveats to that. The purchase price is significantly in excess of or below fair market value. And a price at book value or between fair market and book value is okay. And there's safe harbors for determining, what fair market value is. Agreements to redeem or purchase stock at death, divorce, disability, termination of employment, and forfeiture provisions. The last one is extremely common in purchase agreements where you have substantially non-vested stock that can be forfeited. Generally, those forfeiture agreements under the regs are not going to create a second class of stock. So if there's restrictions on share transfers, again, extremely common, in S corporations because they're generally not going to be publicly traded, so they might be subject to securities law lockups, the Rule 144A and 144 Cap A. So there's probably going to be significant restrictions on share transfers, generally not going to create a second class stock. right? Certain debt obligations that are treated as equity. There's some very specific rules that create some safe harbors about, when a debt obligation won't be considered to create a second class of stock, even if it might be treated as equity under principles of federal tax law. Short-term underwritten advances and certain debt obligations that are proportionately owned. So every shareholder owns the same percentage of the debt obligation. Again, there's some fairly complicated safe harbors that we won't, have the time to go into today. But these agreements, per the regs and per the revenue procedure, don't create a second class of stock. Next slide. So under the regs, as we said, those agreements, not a second class of stock. So the IRS says in the new revenue procedure, we're not going to rule on whether or not a principal purpose of one of those agreements is to avoid the one class stock requirement because it's a factual determination. Like, we're not going to make a factual determination. We can only rule in the law. And so stop sending PLRs, IRS says, on these issues because we aren't going to rule, right? Arguably, you would never need a PLR anyways because the regs say they're not going to create a second class of stock absent this factual determination of a principal purpose to circumvent the requirements. But people, got rulings anyways because they were worried that their S corporation didn't qualify. And so the IRS is just saying, we're not going to rule on this anymore. Don't send them in. They're on the no rule list. You have to rely on the regs and your own factual due diligence. Right? Disproportionate distribution. So again, the S corp has to have, every shareholder has to have same rights to liquidation distribution proceeds. Well, a disproportionate distribution sounds like it violates that requirement. But according to the regs, a corporation is not treated as having more than one class of stock so long as the governing provisions provide for identical distributions, and any distributions that are actually disproportionate or vary in timing or amount are given appropriate effect. That is, they reduce basis and, the amount distributable, you actually treat them as, appropriately under the governing documents and on the tax return as being, an advance or a distribution to one shareholder and, not to another, and you appropriately deal with the basis and the shareholders' interest in the corporation. So again, a PLR was arguably never necessary if you were filing returns and keeping your books and records correctly when you made a disproportionate distribution. So the IRS is not going to rule anymore on whether or not a disproportionate distribution is creating a second class of stock. You just have to rely on your own diligence to make sure that you're treating disproportionate distribution appropriately. Clerical errors on election forms, 2553, 8869. According to the statute, they don't invalidate an S election unless the mistake is relating to a missing shareholder consent required by the statute, a selection of a permitted taxable year, or a signature of an officer to make the election. So there are other procedures available to correct a missing shareholder consent. You've got the regulations allow in certain circumstances an extension of time for filing missing shareholder consents. You've got Revenue Procedure 2013-30. You can request relief for late S election. There are some requirements there. You can only do it 3 years and 75 days after the intended effective date. You have to show reasonable cause. It can only be for the mistakes in the clerical forms. Everything else about your S corporation has to be good. And there are some exceptions to these rules for S corps that have always filed returns, consistent with being an S corp. You can get the 3 year, 75-day deadline extended. So there are some limits to that relief under that revenue procedure. And you've got Revenue Procedure 2004-35, which is very specific and relates to community property states where a spouse is deemed to be a shareholder by community property law and didn't consent to the election. And that's not going to generally be a big deal in Virginia unless they formed their S election while they were, say, a resident of Arizona or California, another community property state. Revenue Procedure 2010-30, that again, a request for extension of time to make the election, can be used to correct an error for permitted taxable year or officer signature. Other errors that are not one of these three statutory requirements can be corrected simply by providing a written explanation, the correctly filled out form, and explanation to the IRS at the address with which the corporation files its annual tax return 1120-S. And there's no reason under the revenue procedure why you couldn't just file this with the corporation's return, right? So when you file your return, you say, here's where we messed up on our form 2553. Here's the corrections. Thank you. It doesn't invalidate our election. Missing administrative acceptance. So this is something that buyers or sellers or new investors will ask for during diligence, because typically the IRS sends you this notice that says, hi, we got your S election, or hi, we got your Q sub election. And so a lot of times the accountants or the attorneys doing the due diligence freak out and go, no, that they never sent the acceptance. The S election isn't valid. And so the IRS says you don't need a letter ruling, to get a replacement acceptance letter. You can just call us and spend 8 hours on hold, like I did the other day, not to get a copy of a S acceptance notice, but you'll pretty much spend 8 hours on hold with the IRS these days. And again, these administrative acceptance notices don't even say that the S election is valid. They just say the IRS got it. So even if you receive this notice, there's no guarantee that you don't, for instance, have a second class of stock, right? So whether or not you even need this is sort of debatable. It's just evidence that the IRS got your election. All right, incorrect returns. So this is more common than you'd think, and I've seen it. S corps and Q subs file the wrong return. Mostly the corporation return, they file out 1120 instead of 1120-S. I've also seen them try and file partnership returns. There's nothing in the code that says that an inconsistent return terminates or invalidates an election. It's just wrong. So the new revenue procedure says the S corp or the Q sub should file an amended return for the open years if they've been filing the wrong return. And the amended return may cause the shareholders to have to file amended returns if the K1s were wrong, or they never got a K1 and reported their income correctly. So the revenue procedure, the new one, doesn't address closed years. Arguably because they're closed. The statutes run if the IRS is out taxed because you filed the wrong return. They're a problem for not auditing the return, right? So you don't have to file for a closed period. And it doesn't invalidate your election, right? Nothing in the regs or statute says it does. So no PLR needed. Just file the correct return if you discover you've been filing the wrong one. This is probably the meat of the new revenue procedure, where I think there is some, real relief to owners and investors of S corporations, is non-identical governing provisions, right? So if a governing corporation's governing provisions, and we're not talking about the commercial agreements that sort of don't count in the first place, if they don't provide for identical rights to distribution and liquidation proceeds, the corporation may have two classes of stock. The new revenue procedure says you can get relief for this without a private letter, right? The eligibility requirements. The corporation has to have had or has non-identical governing provisions with respect to liquidation distribution proceeds. This is an interesting one, okay? The corporation has not made or has not been deemed to have made a disproportionate distribution. So although we said earlier, right, that disproportionate distributions treated properly in a tax return don't terminate an S election, they will, however, make you ineligible to seek this relief for non-identical governing provision. So some of these, automatic relief procedures in this revenue procedure aren't going to apply if there's more than one problem with your S corporation, right? The corporation has to have filed the appropriate return. So again, you can't have filed the wrong return and try to seek relief here, right? Your only problem has to be the non-identical governing provision. And the IRS hasn't discovered it first. Right? You can only, there's this revenue procedure only works if you find it as the S corporation or a shareholder, not the government. The requirements for relief. You have to have a corporate governing provision statement, a shareholder statement, and there's a record retention requirement. So the corporate governing provision statement, what does it need to say? You have to take the date of the statement and identifying information about the corp, its EIN and address, stuff like that. The actual or intended effective date of the corporation's election, identifying information about the shareholder, right? EINs and periods during which they owned the stock. And this is the shareholders who own stock at any time while the non-identical governing provision was in effect, right? So if a shareholder's left, you need to maintain the records about who they were. A description of how and why the non-identical governing provision was adopted, how you discovered it, and what action was taken to correct or remove provision. You also have to make certain statements and representations under penalties of perjury. They're fairly long and they're spelled out in the revenue procedure. I didn't put them in the slides. You can go to Bloomberg Tax or Checkpoint and download the revenue procedure to get what they are. Generally speaking, it's a statement that you haven't submitted a PLR already to deal with it. It wasn't ruled on previously. And if it was, and you're still seeking this relief, you have to have a statement of why. Again, it must be signed under penalties of perjury by somebody who signs the corp's tax return. So the shareholder statement, right? It's some of the same stuff. You have a statement identifying the corp, information about identifying all the shareholders who own the stock, the number of shares or percentage, if we're talking about an LLC that checked the box, owned by each shareholder, date acquired, date transferred if it was, and the date each shareholder signed the statement. So the way the revenue procedure kind of anticipates you do this is the corporation prepares this statement and the shareholders sign it. The shareholders don't have to prepare it themselves. And most of it, frankly, is just language you pull straight out of the revenue procedure, kind of copy it, right? A lot of it's these statements under penalties of perjury. So each shareholder, again, makes the sort of statement under penalties of perjury that they reported everything consistent with it being an S corporation, notwithstanding that there's some non-identical governing provisions. And then record retention. So you got to keep the records of the corporate governing provision statement and the shareholder statement with the corporation's books and records and with its tax returns for inspection by the IRS. Notably, you don't apparently have to actually send the IRS these documents. You just have to keep them, which sort of does lead to the question of, if this is discovered during due diligence, like, oh, quick, let's just do this and fix the problem right now. Does that work? Maybe. More likely, I think one of the ways to kind of deal with this issue of making up a date, right? Because you could say, oh, we discovered this 2 years ago. You can always get these notarized, so that you can show that they're signed on the appropriate dates if you need to. And at some point, there's really nothing stopping the corporation, right? If this is discovered during due diligence, to fix the mistake right before closing, whether or not the buyer or the new shareholder is going to accept that is kind of up to them. They're going to have to rely on the fact that this revenue procedure says this works, and you don't have to go get a PLR. And so, next slide. And that's going to be problematic because this is now a no ruling, right? So the IRS is not going to rule on issues covered by this revenue procedure, with some exceptions, where a corporation isn't eligible for relief for a non-identical governing provision, or because we have to correct a 2553 or 8869, and you don't qualify for the other options for relief. I think one of the areas where you'll see this last one, right, the non-identical governing provisions, be of some use is LLCs that check the box. A lot of LLC agreements for LLCs that check the box and then make an S election have partnership distribution provisions in there, and that just by their very nature, because of 704C allocations, and things like that will create non-identical governing provisions if read literally. And so that's probably going to be one area where this is going to be useful, is to say, I have partnership allocation articles in my LLC agreement that are not consistent with being an S corp. We just never caught that because we used the form and nobody read the form carefully enough. We're going to delete that article, replace it with the article that says we intend to be an S corp, and go through the revenue procedure. And you now no longer need to go get a PLR to fix that problem, assuming you filed S corp returns and everybody treated it like an S corp. So those are, again, no ruling areas now. Next slide. And I think that takes me to the end of my discussion on relief for certain S corp mistakes. Are there any questions about anything that we've gone over today?
One of the questions that came up, Kevin, and thank you, that was a terrific presentation. I think we see, if you read a lot of the private letter rulings, I'd say virtually all the private letter rulings in the S corporation area for the last decade have been exactly what you alluded to, that you've got a LLC that's checked the box, become an S corporation, and then in the course of due diligence, they discover that they have these non-identical provisions. I think according to the rulings, what typically comes up is, you're making distributions to members in accordance with their membership interests, which is fine, but you're upon liquidation, you're liquidating in accordance with capital accounts, which may be different from the membership interest, and that is what creates a second class of stock. One of the questions that was posed in the Q&A is whether or not, is there a time requirement that an S corporation needs to be active before reverting back to an LLC? And I can't recall, I want to say it's 3 years, but Kevin, do you recall, once you check the box, if you can kind of go back, and obviously the consequence is that it's essentially a liquidation of the entity. So you have, 311B gain and then a recontribution, but, arguably, if you could do that, do you recall the time frame for that?
I don't recall the time frame off the top of my head. It's a fairly long period of time, relatively. So if you do check the box, you can't revert back to a partnership for a number of years. But those rules are in the check the box regs. And in the S corp 1361 will have the time frame. It's not necessarily easy to go back and forth. And not generally sort of recommended.
We have another question, and that is, if you have a S corporation, well, if you have an LLC that has checked the box and made an S election, what types of provisions would you want to see in the operating agreement?
So generally, when I have an LLC agreement where I intended to check the box, there'll just be an article that says the members, because it's an LLC, the members agree that this LLC will, make a check the box selection and then will file an S election to be treated as an S corporation, and that all allocations and distributions will be made consistent with subchapter S. Period. I mean, that's almost kind of where you leave it. And then to the extent that, right, like you have a membership interest, and so then allocations and distributions will follow your membership interest. And
I think this is one where the form is not your friend. You really have to go through the operating agreement and think about, this is not a partnership, this is an S corporation. And in every instance when a distribution is being made, it's being made essentially in accordance with membership interest, which is the analog to the stock. One of the other questions which that came up is regarding the distribution or disproportionate distribution discussion. Can you expand on the concept of giving appropriate tax effect? How do you give appropriate tax effect when you're trying to rectify things?
Yeah, so I mean, appropriate tax effect simply means you're treating the disproportionate distribution in accordance with the concept that ultimately distributions are equal among, or not equal, or pro rata based on the number of shares of stock or percentage interest with an LLC that the shareholders or members have, right? So if you make a disproportionate distribution, that reduces your basis in your S corporation stock. So, if not everybody gets a distribution, somebody's, basis goes down, and then you're also sort of saying, that's an advance against future distributions you get later. So if you liquidate and somebody has gotten what amounts to an advance against their liquidating distribution because it's disproportionate, that person gets less when you liquidate the corporation. You can analogize it to tracking your capital account. That that person now has a smaller capital account because they've gotten a return of capital, but it's corporation's not a capital account. But it's the same analogy that you have to true that person up when you liquidate, so that everybody ultimately gets the same distribution proceeds. And when you're allocating items of income, gain, loss, deduction by share number or by percentage interest, so notwithstanding that somebody's gotten disproportionate distribution, they still get the same amount of allocations based on their pro rata interest, the number of shares or the percentage interest. You can't give them less because they received a distribution and they have a smaller capital account. You have to treat them as if they still own that number of shares. It's basically treating it as like an advance against future distributions. And that's, you reflect that on the return, and you reflect that when you track the books and records, right? That's giving it sort of appropriate effect, that it's not a special distribution in addition to your other distributions. That's a second class stock.
Right. One last question, and I think this ties back to some of the more procedural aspects of the revenue procedure is, if you file your S election, but for whatever reason you don't receive confirmation notice from the IRS as to their receipt of the S election, should you assume the election is valid for tax reporting purposes, or do you recommend following up with the IRS prior to reporting?
If you don't get your acceptance letter, you can, like I said, you can call and you can get it, and so that you can prove that the IRS has received it. Generally, I would do that when you initially file. But if you realize later on that you haven't gotten it, I think my approach would be file the return consistent with being an S corporation, because that's one of the requirements for a lot of this relief is, so you have non-identical governing provisions where you're not eligible for that relief if you didn't file as if you're an S corp. So go ahead and file as if you're an S corp and then request the letter. And if it turns out you didn't file it, then there are procedures for late filing relief, especially if you catch it within the first 3 years. My view would be go ahead, file it as if you're intending to be an S corp, so you're eligible for other relief in this revenue procedure.
Okay. Well, thank you, Kevin. I think that looks like that's all the questions that we have for the day, and we've run out of time. Anyway, as previously noted, please look for an email from Williams Mullen this afternoon with a link to the presentation slides, as well as continuing education information about CFP and CPE credits. And thanks again for joining us today, and stay safe and happy holidays. Bye-bye.